Early American finance, barter, trade, and the birth of banks. The United States, in its infancy, relied heavily on barter. In these early days, money was scarce, and people had to rely on trading goods and services directly. Farmers traded goods and services, forming the backbone of the early economy. This system, while effective, had its limitations, especially as communities grew larger. As trade expanded, the need for a more sophisticated system emerged. People began to realize that a more standardized form of currency was necessary to facilitate larger and more complex transactions. The first banks in the U.S. arose to meet this need. These institutions provided a centralized place for people to store their money and obtain loans. These early financial institutions facilitated trade and provided a safe place for people to deposit their savings. They also played a crucial role in lending money to businesses and individuals. The establishment of a national bank further centralized and stabilized the financial system. This move was essential for supporting the country's economic growth. However, the path to a stable financial system was not without its bumps. Financial instability and economic crises were common in the early years. Debates over central banking and monetary policy were common. These debates often reflected deeper political and economic divisions within the country. The first and second banks of the United States faced political opposition and were eventually dissolved. Their dissolution led to periods of financial uncertainty. Despite these challenges, the U.S. financial system continued to evolve throughout the 19th century, adapting to the needs of a growing nation. The resilience and adaptability of the system laid the groundwork for the modern financial institutions we rely on today. The early 20th century saw the creation of the Federal Reserve System in 1913. This monumental event was a response to the frequent financial panics that plagued the nation. The Federal Reserve, often referred to as the Fed, was established to provide a more stable and flexible financial system. It aimed to centralize control over the nation's monetary policy. Its primary purpose was to act as a lender of last resort, preventing banking panics and promoting economic stability. This was crucial in an era where bank runs were common. The Fed's creation marked a turning point in U.S. financial history. It introduced a new era of financial oversight and regulation. The Fed's powers expanded over time, and it played a crucial role in financing World War I. This involvement showcased its growing influence on the national economy. However, the Fed faced criticism for its handling of the Great Depression. Many believed it failed to provide adequate support during the crisis. Many argued that the Fed's tight monetary policy exacerbated the economic downturn. This period remains a significant chapter in the history of the Federal Reserve. The stock market crash of 1929 triggered the Great Depression, the worst economic crisis in U.S. history. The Depression led to widespread bank failures, unemployment soared, and the economy contracted sharply. The crisis exposed weaknesses in the financial system and led to significant reforms. The Glass-Steagall Act of 1933 separated commercial and investment banking activities, aiming to prevent future crises. The Securities and Exchange Commission, or SEC, was created in 1934 to regulate the securities markets and protect investors. These reforms aim to restore confidence in the financial system and prevent a repeat of the devastating events of the 1930s. Section 4. Post-war prosperity and the rise of modern finance. The post-World War II era witnessed a period of unprecedented economic growth in the United States. This growth was fueled by technological advances, increased consumer spending, and government policies that promoted investment. The financial sector played a crucial role in this expansion, providing capital for businesses and consumers alike. Section 5. The financial crisis of 2008 and the blockchain revolution. The late 20th and early 21st centuries saw a period of financial deregulation and innovation. Financial markets were booming, and new financial products were being created at a rapid pace. The rise of complex financial instruments, such as derivatives, led to increased risk-taking in the financial system. These instruments were often poorly understood, even by those who traded them. This culminated in the financial crisis of 2008, triggered by the collapse of the subprime mortgage market. The housing bubble burst, leading to widespread foreclosures and financial turmoil. The crisis led to a global recession and prompted governments to intervene with massive bailouts and stimulus packages. These measures were aimed at stabilizing the economy and preventing further collapse. In the aftermath of the crisis, new regulations were implemented to strengthen the financial system and prevent future meltdowns. The Dodd-Frank Act was one such measure aiming to increase transparency and reduce risk. Simultaneously, a new wave of financial technology emerged, with blockchain and cryptocurrencies at the forefront. These innovations promise to change the way we think about money and financial transactions. Bitcoin, the first and most well-known cryptocurrency, introduced the concept of a decentralized digital currency. It offered an alternative to traditional banking systems and sparked interest worldwide. Blockchain technology, which underpins Bitcoin, has the potential to revolutionize various industries, including finance. Its decentralized nature ensures transparency and security in transactions. While still in its early stages, the blockchain revolution is transforming how we think about money, transactions, and the future of finance. The possibilities are vast, and the journey has just begun.